So first of all, I would like to welcome all of you who've come today. And I wanted to introduce you to Brendan today because he is a very experienced
Hi,
real
everyone.
estate investor. He's been investing for over 20 years. He has a lot of experience in different areas of property investing as well. He has a great track record. He has a great track record also in the media, and he's going to share some really wonderful things. Now, some of you may know me, some of you may not know me. I'm the organizer of the Sydney Cash Flow Club here, and we're expanding a little bit further out from just Sydney. But one thing that I tell everybody that's a member of the Sydney Cash Flow Club is that it's not just about playing the game. It's about going out and taking action and doing things in real life. So we wanted to organize today in order for all of you to be able to learn some new strategies, educate yourself further in order to then be able to learn from somebody like Brendan, who has years worth of experience, so that you can start taking the confident steps that you need to start getting into the game for real life. And if you already are investing, to be able to do it in a much better, more structured and more profitable way. So without further ado, I'm going to introduce you to Brendan, who will take over and mute me, and he's going to share all of the knowledge and the learnings and get you making some money.
Okay. Thank you so much for that lovely introduction, Menno. I'll take it from here. So yeah, just to give you some context, everybody. So this is basically a webinar of three companies coming together. So Menno and his Sydney Cash Flow Club and business coaching. And then we also have Igor Vasiliev. He does financial trading. And so the three of us have known each other several years now. We thought, look, this particularly in a time like this, when a bit of a crazy 2020 is just like what type of time, might be a useful thing to just get some of our content out that could be quite relevant to all of our databases. So yeah, I hope it's valuable for you. Just to give you the quick agenda for this evening, I'm just going to go through a variety of things. Then at the tail end of that, I'm going to leave some time for questions. We might not be able to get all your questions in. We'll obviously do what we can, of course. I'd love to get to all your questions. Throw them into the chat box. There's going to be like a little chat box there. You can type your questions in. As I said, we'll do our very best to get to the questions at the end. Bearing in mind, at the end, there will be an option to actually take this to like a personal level, one-on-one, with a consultant that would be looking at your specific situation. Truth be told, that's far more powerful for anybody that's actually looking to take action and buy some properties, because it's not just about the theory, as Menno was just pointing out. It's far more about, well, what can you actually do yourself in your own circumstances? So yeah, far better to actually get specific to what's possible for you. So I might just kick us off just with a bit of an explanation of how we all work. So yeah, as Menno mentioned, I've been buying investment properties around Australia for the last 20 years. So really very much buy and hold. I'm a big advocate of the long-term buy and hold strategy and staying in positive cash flow territory. My experience has been people that build big portfolios, they only do that by staying positive cash flow. It's simply not sustainable or scalable to continually stay in negative geared territory. Quickly, the banks don't want to lend you any money. It's very risky. You run the risk of losing the property. Not great. So that's been the last 20 years. In terms of actually working in this industry, I've been in the industry for 13 years, since 2007, fulfilled a variety of roles within the buyer's agent side. So they obviously have selling agents and buying agents. We work on the buyer's side, so people that are looking to build wealth through a portfolio. I have been doing that about 7 years now. So back to 7-8 years. So 2012 is when we got started there. And then Byers Club, so this specific company, has just been the last 2 years. So we started that mid-2018. So just so you have a little bit of history about where this has all come about. So I started this with two other partners, Samara Metri and Ali Halak. So anyhow, you may meet them in due course. Anyhow, so I would like to start us off. I'd like to always try to be very concrete about things rather than kind of talking in generalities. So I'm going to go straight to what does the relationship with somebody like myself and our team, what does it actually look like and what are the results? Just cut to the chase. So then you kind of have context of to what we're actually talking about. So what you're looking at, guys, this is the largest property investment magazine in Australia. It's called API, or Australian Property Investor. So if you want to look it up, they actually do have some good content. apimagazine.com.au is the website. I've been very lucky. I've had several of my clients, since I started in Byers Agency in 2012, several of my clients have been published in the magazine, basically for having quite impressive portfolios or having bought properties perhaps more quickly than what people might expect. Something that's noteworthy, remarkable enough that they want to obviously write a story about it. So I'll just run through a few examples. These are just 3 of the examples here. This is important because it really outlines the long-term nature of the relationship we have with our clients. It's not something that happens in an evening, like tonight, definitely not. It's really something that happens over many years. So it requires people to really have a long-term outlook for the portfolio. Another point to take away, very much along the lines of if you followed Robert Kiyosaki, I mean, it's what Menno teaches his people about with the cash flow board game, etc. It's in the long run, you're going to realize income does not make you wealthy. It's assets that make you wealthy. So assets and the passive cash flow that come from them. So you can work your butt off all your life in a job or a business generally and save. You're going to struggle to come away with any decent, serious amount of money, whereas assets can passively grow into many multi-million dollars of equity and then quite significant amounts of cash flow per year. So let's focus on the first one, Todd. Todd is one of my very first clients way back in 2012. He's from Newcastle. So when I met him, he had a home already paid off. So it's worth $525,000. It was all paid off, so it's all equity, but he had no cash. So he actually thought he was wasting my time. He's like, I don't think you're going to be able to do anything with me because I don't have any cash. But I said, hang on, let's have a look. So these numbers that you're looking at, that's where he was at. Okay, so the top line of the table, that was the 525. PPOR means principal place of residence that he already lived in Newcastle. What I basically did there on those properties below it is my strategy to him was pull out chunks of roughly 50K as debt. So you borrowed against that home. And we did that actually 5 times over. The reason for the 50K is that roughly covers deposit and costs for each property. Okay. So 50K times 5 is 250K worth of debt. So that gives you, if you run some quick numbers on it, 250K debt at the time was about a 4% interest rate he paid. So that's $10,000 per year. It's costing him to do this, which is about $200 per week. So that's in the negative cost. And that has got him up to a portfolio of $2.4 million at that time. If you look down the current value column, yeah, so kind of just here, you can see there. You can see where my cursor is, yeah? Now that's that $200 a week. What I said to Todd is we can find properties that are going to be well and truly more than the $200 a week that you're out of pocket by pulling that money out of your home. We can find properties often for clients that are, in the range of say $8,000 to $12,000 a year in your pocket after all costs paid. So that's like a genuine profit in your pocket. So mortgage and all the other costs that go with it. So well and truly, he'd gone from a home to 6 properties relatively quickly, but his actual income week to week had actually got better than when he first sat down with me. So I mean, that's a skill to be able to run a portfolio in such a way that you actually are increasing your income as you're acquiring assets. That's a skill that obviously we help people to achieve. So we do reviews every single year on our clients. Todd, last valuation review I think we did last year, he was sitting at about a $4.5 million portfolio and his equity was sitting at about 2.1. So just over $2 million if he sold it all up, he'd be sitting about 2.1 in his pocket. And that's been, what's that been? Coming on 8 years now since we first started in September 2012. As you can see on the second line there, September 2012 was the first property. As you can see, about a year later, he came back to me. And that's where the headline of the article comes from, because you can see there from August 2013 to January 2014, he bought 4 properties in 5 months. Okay. And that was again, just using that equity out of his home. Okay, so that's Todd. If we go across this handsome rooster here, Robert Chevet. Whoop. Okay, so Robert, he was like the opposite scenario to Todd. He had quite a bit of cash saved up, so close to 200K that he'd saved during his 20s, but no equity, no properties. So you'll notice they're not on particularly high incomes. Todd was on about 80. Robert also was on around 80. So you don't need to be on superstar incomes to be able to make this work. It's about how you use that income, obviously. There you can see, if you've got good eyes, December 2013, if you focus in on that table, you see we actually bought him 3 properties in 1 month. So rather than just dump it all into one property like people typically do, I've actually suggested let's diversify our risk into smaller loans, so smaller amounts of risk, higher cash flows, so that overall those 3 properties would have significantly more total rent than buying one property, okay? That's something you'll find almost universally across Australia. If you go into smaller price properties, the total rent you'll get from all those properties is much greater than what you would get from one property of a larger price. Yeah? So it's a good way to diversify and hedge our risk. So that was 3 at that time. He's gone on board another 4 since then, so 7 in total, because it's been coming up to 7 years now. His equity last we checked was sitting at about 1.7. Yeah, if he sold everything up, he'd come away with 1.7. Okay, if we go down to the last guy. So this is Denny Jones. Denny, local Sydney boy, again, similar type of salary, 80, 90,000, somewhere there. Now he actually already had a property when he met me, but I very rarely would tell somebody to sell. But in this case, I did suggest for him to sell because there's a bunch of problems with the property, very negative cash flow, really poor strata and body corp management in place, range of things. I said, look, let's just cash it all out and start again. So he sold, and then you can see from January to November 2013, so around 11 months, we bought 3 properties there. If you look at the renovation column, 2 of those are actually renovated with my builders. It's one of the strategies we can offer is renovating to force equity into a property. It means you can then top up your loan, take that equity out as cash and go and buy again. Yeah, it's one of the common strategies we use. So it basically, the main benefit is it speeds up how quickly you can buy successive properties. Yeah, he's bought another 4 since then, so that puts him at 7. And last we did a tabs on his equity, he was sitting at 1.8. If he sold everything up, he'd come away with 1.8 million. So that's just 3 examples, guys. And these people, along with a whole ton of other people, if you ever needed any testimonials, these type of things, obviously these can be arranged for people to have a phone call or a Zoom or whatever with our past clients. Not beating the drum, tooting the horn too much. If you've looked us up online, we're doing all right in terms of Google and Facebook. We're currently sitting at 5 stars since the company began. So yeah, we take a lot of pride in making sure clients are actually happy. They're not just buying a property for the sake of it. They're actually having a good experience. So these days, as we all know, online reputation is like super important. So yeah. Okay, so that is the best way I can summarize how the actual relationship works. Probably the burning question people always in the back of people's minds in these type of events is like, okay, so what do we get out of it, as in our company? So that we actually have a few different fee models, and I hope it's not confusing. I'll just explain it to you. We're trying to be as transparent as possible in the fee model that myself and my partners chose. So you do have an option where we could, if we bought something brand new, somewhere around Australia, regardless of where it is, where the builder would then pay us a commission. So it's something like a house and land package, duplex, dual key type of property, and the builder would pay us a commission because we have brought you, the client, to them. Because we're being paid on this selling side of the transaction, if you like, we do not charge you anything. So a typical scenario, someone would put down $2,000 as a holding deposit. Once they've actually gone ahead into a contract with the builder, we refund that $2,000 back to you because we're getting paid by the builder. We believe you should only get paid on one side of the transaction, the buying or the selling, not both. As you may be aware, there's a lot of companies around Australia that actually get paid on both. They'll charge the buyer and they'll be getting money from the seller, like a builder, for example. So double dipping, which as you can imagine creates a conflict of interest. Don't think it's very ethical. So that's one model. So for people that hate fees, don't like paying fees, that would be the one to do for sure. If somebody is happy to pay a fee, so the fee we charge is $14,900 per property. So it's a per transaction basis fixed fee. There are no other hidden or sneaky percentages or anything. It's just that one fee per transaction. All of my staff's time and consultations, reviews, whatever work they need to do month by month, et cetera, that's obviously just all, we've factored that into that one fee. So on that 14,900, our expectation is the buyer should be getting a actual profit in the transaction. So when they buy, they should be able to see for themselves, I've actually made a profit by using Byers Club. So how would that work? If you bought an existing property, so old, then we buy those cheap. So we buy both on-market and off-market properties, but a lot of our contacts around Australia are sending us properties before they get to the market. And if you know how to negotiate correctly with a seller, that's where you can really get quite deep discounts. So most, your average Joe Bloggs out there investor doesn't have access to off-market properties. So it's one of the reasons why people use us to leverage our network and our expertise to access such properties. Now, if you go brand new, the commission I mentioned coming from a builder, so $20,000 to $30,000, we actually pay that back to you, the client, literally like cash, like an electronic funds transfer. So if you, I'm not sure who's following us on social media, but on Facebook and Instagram, you'll see tons of examples of people holding those ridiculous looking, 2 meter CBA checks and with a cheesy smiles for social media. That's basically obviously a marketing thing we do. When people often ask me, what are these checks about? Like, sounds too good to be true. It's not, it's a real thing. All we're doing is rebating back the normal standard commission that we would receive from a builder under the marketing agreement. That's all it is. So as I said, simple principle, you should be able to see that you're either getting equity through a discount on an existing property or a commission coming to you from the builder, literally as cash. Either way, that amount of money is larger than our $14,900 fee per property. So it should create a case where it's a bit of a no-brainer to go with us. That's the way we've set up the fee model. Hope that all makes sense. If there is obviously any questions on how that works, then you can throw it in the chat box, or we can obviously speak after the webinar. Now just go through, I'll probably switch across. Okay, so just a few PowerPoints I've put together. So basically success in property, really like anything in life, is success is work, hard work, plus having a strong reason. This is again what personal development self-help is about, is you need to have a strong burning why. If there's a really strong burning why inside you, why you're going to achieve something, and you've kind of changed it from a could or a should or a maybe or, oh, that'd be nice, into a must, like obsessively, I must achieve this. That's the type of burning desire, as Napoleon Hill, Think and Grow Rich. If you've read that book, that's the burning desire and obsession you want to make something happen, because you just won't accept anything less. It doesn't become a choice. It's just mandatory. This must occur. That's the type of thinking that works for anything in life, whether it's property, sport, business, anything. And then vehicle. So by vehicle, like obviously a metaphor for choosing the right type of financial vehicle that's going to get you there. So obviously I'm a big believer in property. That's obviously got me to a very comfortable place in my life now. Menno obviously gives a lot of great coaching on how to do it through business as a vehicle. Then if you talk to Igor, obviously he's got some fantastic strategies about how you can achieve that through financial trading. So there's many different vehicles, but you just got to, I'm a big believer, anything you're wanting to do in life, choose a vehicle and then stay the path, stay with it, rather than gets a little bit hard, things don't go the way you maybe expected, you're a bit disappointed, and then you start to, then people kind of veer off onto tangents. The point being, you really want to stay with one, because if we're always going for the next shiny, bright, easy looking thing, well, you can probably imagine in the end, those type of people, they just end up going around in circles. Yeah. So I think setting expectations mentally that it is not going to be easy, definitely not. Things have definitely gone wrong in my portfolio. I can tell you all of my fellow investors that have got quite large portfolios there at Byers Club, same. They'll tell you they could rattle off tons of things that have gone wrong since they started buying. But do you throw your hands up in the air and quit? Well, no. If you want to see the long-term results out of it, you've got to stay with the course. So let's move here. Yeah, so obviously, guys, this kind of goes without saying. Anything I'm saying tonight it's very much general in nature. I haven't taken into account anybody's specific circumstances. That's something that you can do. As I said, if you're wanting to bring this down to a more personal level of what you're personally capable of, we're able to tailor it to your own personal borrowing capacities and personal abilities to buy properties. That's easily done. Okay, so why would we want to be successful? So these are the, I suppose, coming at that why. You have to have that really strong burning why to do this, like anything. There's an old saying in personal development says, if you take care of the why, the how is in the domain of the universe. Basically meaning the mechanics or the steps to be able to complete the journey that will somehow magically be shown to you if you actually genuinely want it. Not just lip service and platitudes, genuinely. You are serious about creating that. Magically, you'll start to meet the right people, the right opportunities, the right things happening for you. Yes, we've definitely been true in my experience that events and circumstances and people and so on tend to conspire in your favor because you're constantly focusing on that goal and seeking it out. So look, it's going to obviously be different for everybody. I think these things that I've put in here on this slide, I'd say when I often talk about this, when I talk to people one-on-one, I'd say these things come up a lot. It's sometimes because you really want to, I think, drill down a bit lower. Everyone will say that the standard, what are you trying to achieve? Everyone will be like, oh, the passive income, financial freedom. I've probably heard those two phrases like 17 million times in the last 20 years, which are great. That's true, but let's drill down a bit lower for what hits more on the heart, which might be along the lines of how you can impact your community, be more valuable to your family, be more present and available to your family, travel more, et cetera, whatever that is that actually emotionally, because really emotions are what drive action. So yeah, it needs to be more than just an actual financial reason. So if you can make out what's in this table here. So I've got on the left, there's a graph. It's basically showing what's been happening since 1980. Okay, so I'm not sure if you guys are aware of what's happened to median house prices. Back in 1980, the median house price in Australia, in each of the different cities, that's these lines you're looking at, they're the different cities of Australia. The median house price ranged from $30,000 to $65,000. When we get towards now, okay, these city house prices, they have obviously gone up dramatically, basically now sitting between 450 to 1.1. So this idea that people have of like, you can only build wealth in Sydney, it's not completely true actually if we look at the data. So from 65,000 to 1.1 million in Sydney, that's roughly about 15 times its original value. If you go and look at the lowest city, which is actually Adelaide, it's gone from 30 to 450, which is actually 15 times its original value. So they're actually very similar proportionately. So we've always got to look at things relative to where they started. So Sydney tends to obviously have these kind of big boom periods where it whips up and then it will overshoot it too far and then correct back down. But the others tend to be what you might call more of a slow burn. They don't tend to have that boom period as strong, but you know, it just keeps moving up and up and up and up. So despite all the jazz we see in the media day by day by day, land prices in capital cities, typically they just keep going up year by year. I mean, you might have periods where it flattens off or even comes down slightly in a recession, but generally speaking, land prices just keep going up. So that's why we generally want to have a piece of land, so a landed house, duplex, dual key type of property, because land is where is the asset that will go up in value. You need the building on it to bring you the rental yield to be able to stay solvent and positive cash flow on the property. Then if we look at the individual interests in property up on that table there on the right, so this is quite interesting because you've talked to 20 people, you get 20 different opinions about how to basically build a portfolio. I'm a very big believer, only get your information from credible sources, so people that have already done what you want to do. Very key point. I would say, where do most people get their information about property investing? They would get it from friends, like close friends, family, media, social media, and maybe some Google searching. They're probably the top 5 in my experience, generally speaking. What's the issue with that is often those 5, there's no filtering as to the quality of the information. Friends and family obviously love and care about you, so you can trust they're trying to help you. But if they've only ever bought their home or maybe a couple of properties, do you think they're probably the best person to be asking about how do you buy 20 properties? Probably not. You'd probably get a much better mentor for that. So yeah, you definitely want to talk to someone that's already done what you want to do and follow their advice, not the general advice most people are following. Okay, so the point of this table is it's once we get past home, so property interest means property ownership. See number 1, you got 72.8%. That's obviously a very high number. Yeah, but as we go down the number of properties, see how quickly it drops off. If you look at the percentage, which is the last column, see how it drops off from 72.8 to 18, just even to have a second property, and then down to 5.5 and so on. So when we get down to 5 and 6 properties, you're talking about under 1%. Yeah, so it works out like around, because we've got 25 million people in Australia, you're talking around the vicinity of about 20,000 people in Australia, give or take, somewhere around there, actually own 5 or more investment properties. It's not a very large number, as in you could actually put those people together in one room. Yeah, so for all the talk you're hearing, a lot of it, like I say, I find to be very just hot air. Because if they haven't actually achieved that and bought 5, 10, 20, 30 properties, whatever the number is, probably not the best quality source of information. Okay, so this just a quick brief on, geez, here's a handsome guy. Just joking. That's myself. So we've helped well over 600 clients since 2014. And most of those people, obviously the ones that are more serious about actually building the wealth through the portfolio, much like the 3 that I ran through with you earlier from the API magazine articles we covered a bit earlier. Top client having bought 8 in 3 years, which is a pretty amazing achievement. So I'm just comparing here on investing on your own versus us helping you to do that. Now, first and foremost, don't get me wrong. Buying a property is generally not rocket science. It's relatively simple if you just follow the steps. Yeah. So most people can do it. Yeah. So it's not in any way to suggest that you need to use us. I'd be the first person to say, absolutely, you can do it yourself. You can. And many people have done that very successfully by themselves. However, there's the average person out there, they're very busy. So, you know, they've got families, kids to look after, businesses, jobs, hobbies, other interests. They're trying to have a work-life balance. What a concept. So when it comes to a property portfolio, often that sits in the too hard basket or something that just doesn't have a lot of time or resources to dedicate to it. So I'm a very big believer, property is a team sport. Everybody that's ever been successful in property, whether it's in a buy and hold portfolio or building, development, whatever area it is, they have a team around them that they can trust. Very important concept. So we obviously form that team to outsource a portfolio for our clients. So it's a genuine one-stop shop type of idea. So anything you can imagine in building a portfolio. So ranging from finance broking all the way through the various types of building, then just the little things that need to be done along the way, you know, building and pest inspections, conveyancing, so using our lawyers, the various types of building, so brand new builds, renovating properties, building up granny flats so you can create a second income out of a property. All of these things we cover and advise you on what we think is appropriate at any point in time, but then more importantly, actually do it for you. So our typical client would sign pieces of paper along the way, and make decisions along the way, but they're not actually really doing it. We are project managing all of those services year by year for them. So yeah, I think in terms of comparing investing on your own versus us helping you, you really, it's like we've all heard, you know, you want to, one of the first keys to wealth creation is about leveraging. You want to leverage our time, our experience, our networks, our key contacts that we've built up over the years, so that you have people that do it every day, obviously are going to tend to be a bit stronger at something than somebody that is, you know, doesn't do it every day. They're not a professional. It's not their area of expertise. So it'd be like, if you had a complex legal case going, oh, I'll give that a shot myself. Well, you probably wouldn't. If it was an important, complex case, you're going to engage a lawyer. If you had a serious medical problem, you probably shouldn't be jumping on WebMD and trying to self-diagnose. You should actually go to a doctor that can help you with that concern. It's very similar type of concept. So it's getting experts to do things for you in a professional way, rather than, you know, just giving it a kind of a amateur hack job yourself. And then in terms of, I suppose, more directly, in terms of a return on that investment, like I mentioned before, we only expect someone's going to go into a transaction with us where they can see they're actually making equity in a property, like an existing one, or they're literally receiving cash from a builder as the commission paid back to them. So dollar for dollar, the fee should make a good sense in terms of the return on that investment. So just probably skip across to the bottom right-hand side there. If you can see the last few points on the bottom right-hand side under what we do. These are just some very basic metrics that we will focus on for our clients. So greater than 7% capital growth in the suburb. So it's always suburb data that's important, not like a generalized type of metrics for a city. We want to look at a suburb. We also then get a greater than 5% rental yield. So you'll only get between, say, 2 to 4% rental yield typically here in Sydney or Melbourne. They're the lowest rental yield cities in the country. So to get more than 5%, a target range for us would be between 6 to 8%, okay, which will generally, that's going to put you comfortably into positive cash flow side. So you are actually putting money in your pocket after all the costs are paid for the property every week and every year. The last one, the third metric, is occupancy or vacancy. Okay, so they're basically the opposite of each other. So we want to get less than a 3% vacancy rate. So typically it's often 1 to 2 that is we're going for in suburbs. So if it's sitting at a 2% vacancy rate, what does that mean in real terms? It means you should have, on average, 1 week of vacancy per year, which might be time when you're switching between tenants, for example. And most people are, you know, pretty comfortable to deal with that. Because I've stuck to this metric very strictly in my own experience, in my own portfolio, longest I've had something sit vacant in 20 years is about 3 weeks. It's actually not very long. But you really need to stick very strictly to that little vacancy rate rule. On top of that, just to let you know, we can also get rental guarantees from property managers, you know, Ray White and McGrath and so on that we work with, or the builder if you're going to build brand new, because that's their way of getting you on board to get your business. But yeah, don't get seduced by, you know, a rental guarantee, because I think far more important is the vacancy rate that's going to exist in that suburb after the rental guarantee ends. The last point actually I should probably say sitting underneath that is you have 3 factors that really influence these ones. So if you imagine those are like your headline kind of stats that we want to focus on, below that, you have 3 other things that we also look at. So this is investment in infrastructure. So typically would be from the local council, state government and federal government. Then you'd also have population growth, so into the area, and also jobs growth. These are 3 key numbers you want to know, because they will directly influence the 3 that you're looking at right there. If you go then a step further down again, then you're starting to get into like property economics and micro and macroeconomics of the domestic economy, the broader global economy. For most average property investors, they probably don't need to understand that too deeply, because that's getting more into like what an economist would do. You don't want to be getting too academic about it. At the end of the day, you just want to know that these top 3 numbers here and the other 3 I mentioned, they are the ones you really want to make sure are in place for the suburb you're selecting. Now, how do we access this? As you probably picked up, I'm not a big fan of just people's subjective opinions. We actually buy our data, our research from external companies. So one we get a lot of our data from is Terry Ryder. He's based up in Queensland. He's been analysing the whole Australian market since the 1980s. So it's been over 30 years, very long time. Fair to say, he definitely knows what he's talking about. We would always feel more comfortable in following his recommendations rather than someone's opinion, even our own. We're not necessarily even following our own opinion. We're going to always go with objective third-party information. Okay, so then you can see here, this is quite important because this is what we call a due diligence pack. So when a property, so someone comes on board, we generally get them a loan, or we might set them up a self-managed super fund or a company trust structure. So there's different entities that we can buy within and different structures, and they have their own pros and cons, which again, I could go through more with somebody individually. Once that's set up and they're ready to buy in whichever structure we've chosen, then we go do a buyer's brief, the criteria, the location, the price, the rental yield, et cetera. Then we go find that either from builders or from a private seller. We then email it to you. So we tend to email properties to a client 1 or 2 at a time for them to consider. These are the 3 documents that come across. So the evaluation, so that's going to include recent comparable sales in the market, cash flow spreadsheet. So that's going to show you, is it positive or negative cash flow, and what is the rent and what are all the costs associated with the property. And lastly, a research proposal. So that's on the house and all the surrounding area and the factors that would affect the purchase. So these are really key. That's generally the bulk of what you need to be able to make an informed decision. And then somebody will say yes or no to the property, and we just keep a little bit of a game of tennis kind of back and forward, and eventually somebody finds a property they're happy with and they obviously sign it up, and then we proceed through to settlement. It's a basic process. Okay, so this is our little flow chart. This generally takes about 3 months typically, 3 to 4 months. Let's call it 3 to 4. So roughly speaking, from somebody, they sign on with me and we get started, generally we'd say maybe a month to get your finance and or structure set up. So a self-managed super fund and or a company trust. Then about a month to find your property you're happy with to sign. And 3rd month for settlement, when then tenant in place, obviously rent starts to come in through the property manager. So as I say, 3 to 4 months is typical. So somebody coming on board in September now, I would expect they would be done by January. Yep. So you can see there, first box, someone, that's the fee, the $14,900. Typically we do that as half and half. So as in somebody puts down $7,450. Then after they have successfully transacted the property, it's been bought, then the other half of that, so $7,450 again, would be payable. Now, if they can't get finance, or they can't, for some reason, they're not able to set up their self-managed super fund or something like that, means that they're not able to go ahead, then obviously that $7,450 would be refundable. Finance, we can see there, get your loans in place for whatever the structure is that we are using, buying brief, criteria, then we go to the sourcing of the property from a builder or a private seller. Then you go down to the 3, present, select, and then make an offer. Then we go through to settlement. Once we actually signed a contract, all the stuff that needs to happen between then and so the signing of the contract to settlement, we obviously take care of all that for you. Can be a little bit stressful because there's a bunch of emails flying around typically. So conveyancing, that's your lawyers, building and pest inspections, and then also introducing you to your property manager and getting a tenant ready. So we're either going to switch managements perhaps for an existing tenant, or if it was a vacant possession from an owner occupier, then we would actually market it afresh through our property managers, so we have a tenant ready to go in on settlement days, so you're not out of pocket any days without rent. There are some searches that we do in this process as well. These are really important. People often forget about these, but these are really, people often ask like, what are the risks? Well, these are 4 searches that you should do to mitigate those risks. So they are a flood zone search, a fire zone search, title, the title of the property, and easements. Easements are things that run across or affect the property. So things like sewer lines, electricity, power boxes, could be like council rights of way across the property. Might not be actually a major concern, but you at least need to be aware of all of those 4 things and whether that actually is material to the risk of to a risk in buying the property, or whether it's all, you know, it's all fine, it's all kosher, we can go and roll through to settlement. So then we get across to, you'll see there are also the different types of building that we can do. So renovation, granny flat, new house build, and off the plan build. We would obviously advise you on all of this. That's what we do, is giving you that advice. At the end of the day, it's up to you though. Like, you are the client, so people listen to our advice. Some people follow because they're like, well, you guys are the experts, I want to hear what you got to say. Other people have their own ideas, and that's completely okay too. We can obviously be guided by their ideas if they have a strong requirements for what the property needs to be like. Okay, so then once we have finished that, we basically would review. So people signing up now, I would then review with them when we get to the end of this process, say in January, and then we go to revalue that property, refinance it, potentially at the appropriate time. It's obviously not immediate, to get equity out of the property, and because that can create our deposit and cost to go into the next property. And then you can see reinvest into the next, and then repeat that until you reach your goals. And reaching those goals and giving someone a bit of a trajectory of what they can actually achieve over the coming years is one of the things I can do with you in person based on your real numbers. Yeah, as you saw back in the API magazine articles, I mean, those guys, yeah, it didn't happen by them sitting down with me once. It happened by them working with myself and my team over 7 or 8 years. So there's a lot of phone calls, a lot of ongoing work to make it all happen. Okay, so this is just touching on leverage. So leverage is a very basic, I think most people understand what leverage is, really using a loan so that you can increase the total amount of asset that you have working for you. Or other people's money. You're using the bank's money to become wealthy. So these are just some of our key points that we'd want to have in place. So you see the first one, they're having positive cash flows. We've talked about the 3 metrics: capital growth, rental yield, and a low vacancy rate. The next one there is use equity whenever available, because you're trying to get yourself into as big a portfolio that is positive cash flow still as quickly as possible. Why do I say that? Some simple maths. Imagine somebody is sitting on a $4 million portfolio and they get just a very mediocre basic capital growth rate, like 5% growth. 5% of $4 million is $200,000 a year. So you're actually getting $200,000, which is compounding, because it's a compounding growth year by year. 200 grand is, well, for the average Australian, that's definitely more than what most people are making from their job. And this is happening whether you roll out of bed in the morning or not. It will happen. It's just going to happen passively in the background. Long-term buy and hold, next point, 10 to 20 years. I think 10 to 20 years is, like, for me personally, I think is the minimum. So I've personally never sold a property. I've bought a lot, but I'm not a believer in selling unless there's a really strong reason to do it. I would always prefer to pull equity out of a property if I was needing extra cash rather than sell. Why do I say that? When you sell, what happens? Generally, if it's an investment property, you've got capital gains tax that you lose the ATO. And it's typically, for someone on a good income in the year of sale, you'll probably pay 24% tax. Can touch on a strategy about how we can avoid paying tax on properties shortly. I'll touch on strategy soon. Then also, when you go to sell it, you've got agent costs for the agent that goes to sell it for you. And then what happens when the money comes cashed out? Then usually people go and reinvest back into a property again or something. And then usually that has more transactional costs to go in, such as stamp duty, conveyancing, building and pest inspection. So I would always prefer to pull equity out, because when you pull equity out, yes, you pay interest on the extra bit of borrowing, but we're only talking about, what are we talking here? 2.5%, 3% at the moment. lowest interest rates in Australian history, and there are no costs. You're not paying any tax, any costs. So it avoids all these transactional costs, because that's one of the major downsides of property is transactional costs. The transactional costs are high. So we want to minimize that. So, and then get our head out of buy, sell, trading mentality, which a lot of people have, over to acquisition and growing, accumulating a portfolio mentality. Yeah, always better, in my view, to get to the next property and the next and the next, rather than buying and selling and trying to cash out more and more as we go. So I hope that makes sense. Opportunities to make money in each deal. So this is very pertinent in the current market. People, I think good advice is wise investors are always looking for opportunities to make money, no matter what type of market they're in. Okay, so not just your typical person that jumps on the bandwagon and wants to do it like when Sydney's running like a bull market and every man and his dog overnight becomes an investor and wants to buy a property. It's also in a time like this, I think a couple of things that would be important to people is making certain money in the transaction. So it's like things like buying off market, getting sharper wholesale prices from builders, getting cashbacks from builders. So the old saying is your profits are in the buying, because it's a certain profit today. If you made money today, nobody truly knows what's going to happen in the next few years, but you've made a profit today. And then if it's positive cash flow, you're like, well, this thing's not costing me a cent. It actually pays me an income to hold these properties, and I've made money today. That's what a smart investor should be doing in this current buyer's market that we're in. So that's something to really focus on. The other thing would be debt reduction. At a time like this, people are less focused obviously on growth, because many areas around Australia now are kind of a question mark on growth, whether they're going kind of up, flat or down. It's definitely not, a strong bull market that we had a few years ago. So you're wanting to reduce debt levels as much as you can, which we have a strategy for that as well. I can touch on that. The other one is then, this is pretty standard, having a diversified portfolio. So locations, styles of property, brand new versus existing, different structures, personal name, company trust, self-managed super fund. These are all ways that you can diversify that risk out. Yeah, and again, it comes away from, I suppose, your more typical amateur investor that only buys in their local area. And again, I would probably suggest to people to consider whether that's actually wise, because it's like saying magically my local area happens to be the best place to invest in Australia. Well, does it? Usually the answer to that is not necessarily. There are often better opportunities around the country. So as long as you have a team there that have local people on the ground that can help you with whatever's needed, then that means you can genuinely buy nationally. Okay, so these are just some basic properties. These are not particularly amazing, just some very standard kind of property deals we've done recently. So you'll see the first one there. It's actually like a very recently built duplex. So meaning it's symmetrical, side A, side B. So you actually have two tenants in there. So two rents being created. The purchase price was 600K. The comparable sale, so the valuation done was at 630. So we'd basically saved $30,000 below the valuation for our buyer, and it's tenanted at 650 per week. So this is a 5.6% gross yield. If anyone's not familiar with gross yield, it's pretty simple and very useful to remember. It's the annual rent you receive divided by the purchase price. Okay, and that allows us to compare all of Australia. Sydney and Melbourne, as I said, you're sitting between 2 to 4%. We have a target typically to be between 5 to 8 in that range, which pushes you across into positive cash flow. Second property there, this is 340,000. The valuation was at 360. So that basically we've saved 20K for our buyer. Rent is 360, 2017 build, so 7 years old now. And that works out at a 5.5% yield. So a pretty standard type of investment property, that one. Third one, more of a high yield. This is up at 7%, as you can see. So bought it for 415. Comparable valuation was 440. So we've saved 25,000 there. And it's tenanted at 560 per week. So it's actually an old house at the front with a granny flat at the back that's just been built in 2016. So the granny flat's relatively new. Yeah, so just to give you some examples. And yeah, don't take from that we only buy around Brisbane. That's not the case. It's all up the eastern seaboard is fair to say. We don't touch much across in Darwin and Perth. there's honestly, people are not even interested. It's not on their radar. But anything kind of ranging anywhere from Adelaide all the way up kind of Melbourne, Sydney, all the way up to Southeast Queensland, all of those cities along that stretch we buy in. Testimonials, these can easily be arranged, guys. We have plenty of people that have been kind enough, generous enough with their time to give their phone numbers out, that if you want to arrange a call, have a chat to them about their experiences. They'll tell you the good, the bad, the ugly. They're not biased. And if that helps you, then can easily be arranged. Most people, that would probably be the last thing they'd do before signing up. They would meet with me, get all their questions answered, understand what they could do in their own personal situation. And then once kind of dotted the I's, crossed the T's, done their research, happy to go ahead, then they might want to talk to a couple of people over the phone. That's completely fine. We can arrange that, not an issue. You'll find a whole ton of testimonials on our website and also on the Byers Club Sydney Facebook page and Instagram. That's probably the website, Facebook, Instagram, probably the 3 best places to find those testimonials. Cool, so back online. Okay, so I'll just quickly, in the little bit of time we've got left, this will probably be maybe a little bit of a download, but I'm just going to run through quickly the 2 main strategies that I use in my own portfolio and that I teach my clients. And then we obviously do all the tasks necessary to put this into action, but just from a high level to try and explain what it is. So the first is about how we're actually going to be able to create debt-free properties that we can live off, passive rental income to support early retirement without paying any tax. That's the key point. Tax is the killer in Australia, as we all know, a very high tax country. We want to get ourselves out of paying tax wherever possible. The way to do that is you actually build 2 portfolios, one in your personal name and one in your self-managed super fund. Okay, they have separate borrowing capacities. Self-managed super fund, you can generally borrow up to 80%. Okay, so it means, again, leverage. You can acquire a much larger asset in terms of property price than the cash amount you have sitting in your industry or retail super fund right now. Eventually, when you're looking to exit, the properties you're going to want to sell in retirement are the super properties, because in retirement, there is 0 capital gains tax. Okay, very important point, 0 capital gains tax. Also, no rental income tax. So any properties left in an SMSF, you would be paying no rental income tax on that as well. You then would want to, so you've sold the properties in super, that money comes to you personally. You would then use that to pay off any remaining debts or mortgages in the personal name. So they're now debt-free and clear, and you can just live off the passive rental incomes of those properties. That's the basic strategy. It's not terribly complex. It doesn't need to be. It works. It's the only strategy I know that allows you to create passive rental incomes without having any debt left and without paying a whole chunk of tax to the Australian Tax Office. In conjunction with this, and again, just at a high level, because we can actually create a report for you if you like, with a report will show you the exact saving in time and interest by using the program. As you're building up properties, 1, 2, 3, 4, you are going to divert all of your forms of income back to an offset account that sits against the loan of the first property. So this would typically be a home for most of our clients, but if you don't have a home and you're rent vesting, could just be the first investment property you bought, for example. You just choose one property to focus on is the point. The incomes you're going to divert to the offset account are your job or business income, whatever it is, your rental incomes of those properties, tax deductions, which come through the ATO. You can actually access them weekly. It's a thing called an income tax withholding variation. So if you're going to receive a total of $20,000 of deductions, you notify the ATO of your properties. They then tell your employer to add an extra $400 a week to your pay packet, because $400 a week is obviously the same as $20,000 a year, but it's actually in your pocket. So then that literally becomes a weekly income that you, again, put that straight into the offset account. And then any other types of income you might have. If you have shares or other types of income, every single dollar coming in week by week is going directly into that offset account. Why? If you understand how the banks work, they will calculate your interest daily, every single day throughout the month, but they only bill it to you at the end of the month. And so literally the monthly charge is the summation of the 30 daily charges throughout the month. So we want to keep that balance of offset as high as possible, so that it's meaning that your net loan is as low as possible day by day by day. I hope that's making sense for everybody. I'm obviously happy to explain it further for people, but what does this mean in real terms? Once we actually do this, like you look at your loan, yeah, somebody typically paying it off over 25 years, for example, people are often just like gobsmacked when we actually produce a report and show them. Not crazy to often get that down to say 10 years. Obviously there are variables here. Everyone's on different incomes. Everyone has a different financial circumstances, but yeah, very commonly we get it down to, could save 10, 15 years off that loan, which of course means you're usually in the 6 figures worth of interest has been saved, which is directly to your pocket. Once that first property's paid off, you get the title back. What do? Obviously, take all those incomes again and put them straight into property number 2. Repeat the process, and then property number 3, and so on and so on. So that by the time you get to retirement, you should have some debt-free properties already, and then come back to the first strategy I was explaining about the super fund. Then you would use the self-managed super fund to sell off properties in there, use that tax-free cash to go and pay off any remaining debts or mortgages. So I hope that makes sense, guys. It's basically 2 strategies actually work hand in hand. They complement each other. Again, they don't need to be very complex. They're relatively simple. I think often people try to make things more complex than they really are. Often the simplest solution is the best. For me, the average person can do it. So we want it to be something that's not super technical or too difficult. It's something that literally almost every person I meet has the ability to do those strategies. So yeah, we'd obviously make that all happen for you. Okay, so guys, that's probably, I think, enough for today. I've just run right on time, so right up to 7:30 there. I will just guide you. If this is of interest for everybody on the call, then the steps basically would be this. I'll show you how to go on to book a meeting. So just a standard contact page. And I spoke with my business partners and also with Menno and Igor earlier this week, and happy to do some type of incentive. Obviously, you guys have spent the time to come and learn about this with me. If you're to book a meeting in and then you actually go through with it, so we said within the next 7 days, we'd be happy to give a 20% discount. So that brings your $14,900 fee down to $12,000 flat. Yeah, and as mentioned before, you should be able to see, I can show people quite quickly in person, that they'll be getting an equity in a property versus the bank valuation versus the contract price, or they're going to be receiving like, $20,000 to $30,000 cash in their hand from the builder, basically as the return on investment on top of that, on top of the $12,000 fee. After that time, obviously, life rewards action, right? So we're rewarding people that take some action as a result of this webinar. It's obviously education's one thing, but knowledge is only powerful if you apply it. I think we all know that. There's no point just knowing everything. You've actually got to do something. And action, investing is very much about action, more so than just theory. So I'll just guide you through that. Okay, so this is the site, guys. This is how you register for a meeting. You basically just put your mobile and email in. So it's byersclub.com.au is our web address. That's us there. If you scroll across, you see contact. You can just see here. We click contact. Okay, and then down the bottom of that page, you can see contact us. It's that easy, guys. Yeah, so obviously you'll get a confirmation to the email that you provide there. We'll send out like a brochure, a little information kit. So you have some information to start off with. And then we have obviously guys that do appointment setting on the phones. They would be in contact with you. Probably they would have contacted you actually about tonight's meeting anyway, just to say hello and remind you of the meeting. Then they'll do the same. They'll come together and let you know what the details are for the meeting. Obviously, just work out a mutually convenient time. We have offices, just to let you know, up in Balcombe Hills. That's our main company office. Then I run a home office from where I'm sitting right now. This is my penthouse at 1 Central Park, so it's right next to Central Station. Or third option, we come out to see you. So it could be at either your home or often we meet at hotels, et cetera, et cetera. So whatever's going to work, basically. That's basically it, guys. Hope that was useful. I've talked a hell of a lot. I've talked too much. But yeah, really enjoyed spending the time with you. Menno, anything you needed to add, mate?
So I have some questions that I've compiled.
Oh, okay.
And, are ready to answer a couple of questions, then I will read those out to you.
Sure.
Okay, so Mladen asked the first question. He says, I'm 59 years of age, no income for more than 1.5 years, receiving unemployment benefits, no own assets, debt-free, 160,000 in super. And he was wondering if there's any strategy to start investing in real estate or whether you think it's too late for him.
Age 59, 160 in super, but unemployed, yes?
Yes, correct.
Yeah. So yes, within super, yes. A lot of people don't know this. Because they look at the rental income of the property and also the super contributions, even without ongoing contributions going in there, you can generally still borrow up to 50% of the property's value. So with numbers like that, roughly around 280K. So you put 140K loan from the bank, 140K of his own super, takes you to 280, and obviously that's leaving him over a buffer of about 20K to cover, stamp duty, etc. So yes, would be possible.
Okay, great. I hope that answers your question, Mladen. And I also have a question from Aaron. If I already have a property, how much do you charge for project management, building of granny flat, DA, and build?
Sure. Obviously, we'd have to quote it. We'd get our guys, just our granny flat guys in that particular area where the property is, to go out and just do a quote and provide it to you. Yeah, that's quite easy to arrange. Hard to really say what that figure is going to be without me knowing the specs of the property, where it is. Obviously, that's why we partnered with granny flat builders, because that's their job to quote it.
Of course, if anybody has further questions, then they can book an appointment. But at least, okay. The next question is from Jay, and Jay asks, do you have Airbnb or short-term rental options for the right property?
It's an interesting question. Look, holiday letting is obviously similar to Airbnb, can be arranged. It just depends, I suppose, on someone's risk profile. Like if somebody potentially Airbnb and holiday letting obviously can return a higher return if there's sufficient occupancy, if it's in demand. The safer option would obviously be to have a long-term lease, like 6 or 12 months, but might not have as high a return. So yeah, that's something we that can be discussed for sure. The person just needs to be aware that if it doesn't get rented a good occupancy rate, obviously that's the risk that they take.
Okay, I hope that answers your question, Jay. Then the next question I have is from Chris. And he asked, how would pulling equity out of property from self-managed super fund investments work? I think you touched on it lightly, but you might want to answer that a little bit further.
Sure. So you're not allowed to take equity out of investment properties in a self-managed fund. The government doesn't like any situation that's considered risky, and increasing debt level in self-managed super fund is not allowed. So the strategy is then, well, how do I get to my second, third, fourth property? Generally speaking, it's through the contributions you're making from your workplace situation. So from the employer, and you can also do pre-tax salary sacrifice. That total amount coming from employment can be up to $25,000 per year before you go into surcharge territory. So very commonly, people will contribute $25,000 a year. It's a good amount. Or you can actually make cash contributions. You can do cash contribution from your saving of $100,000 per year. So that's going to be the fastest way to build up cash reserves, to have a 20% deposit, because we always need at least 20 to be able to get the next property. Yeah. So if you go and sit with accountants and financial planners, they will often give you the advice, put extra money into super. And that's why, because it's tax effective to get the money in there, and also tax effective on the way out, as we discussed before, when you go to sell them and you get to retirement. So on both sides of it, it's a very tax effective vehicle.
Okay, perfect. So I hope also, Chris, that answers your question. If you want to ask further questions, we don't have any more left, so you can still add anything into the chat, and I'll compile those further. Then the next question is from Jenny. She asks, what should one do with a positive cash flow property that has fallen in value? Hold or sell? $1 million question, that one.
That is. I'm not a fan of selling. If the property, if we assume it's in a capital city, because I don't know, if it's in a capital city, my belief is land in a capital city, it's going to continue to go up. As we looked at the graph much earlier of what's happened since 1980, it's, we're not talking like a mild increase. You're talking like 15 times its original value. So yeah, you just need to give it time to correct. It will correct, but you just need to give it the time. There would have to be really strong reasons. Like you saw there earlier, I did recommend Denny to sell his first property that he had, but that was for other reasons than that. There was very negative cash flow. The building was in really bad shape. It was an apartment building. I'm not as much of a fan of apartments. We do buy them, but not as much. And yeah, Strata and Body Corp were being run badly. So there would have to be a really strong reason why a property just looks like the person had bought something that's not going to perform for the foreseeable future in order for me to think that selling would be a good idea.
Okay. Thank you for your answer, Brendan.
Sure.
And then a couple of people asked you to go a little bit deeper into buying off-market properties. So obviously you talked about the buying power of Byers Club and the different ways that is the advantage to buying off-market properties. Tim Atkinson, who's actually a member, also mentioned that he is an existing client and asked a question about that and mentioned that he'd also like to hear a little bit more about off-market properties. So I was wondering if you'd be able to do that. And yeah, maybe also have a look at Tim's question, see if you'd like to answer that one a bit further.
Yeah, sure. It's quite easy. So over the years, we've built up contacts around the country that send us properties every day. The most common type of contact is actually like a selling agent, because what will happen, say they go out to do a listing presentation to sell a property for a client, and then they realize that person's actually quite, has an urgency. They're trying to sell it quickly. They might not want to pay all the, vendor paid advertising that they would have to pay to a selling agent. Then they'd contact us and we would do a deal direct with that seller. And so if we had a buyer that's looking for something similar to what they have on offer, then we would obviously say, hey, communicate that to the buyer and say, this is obviously, the necessary information about the property, the valuation, the contract, the cash flow spreadsheet, the research proposal. We'd send that to you, and then you would decide whether you wanted to go ahead with the deal. So it's no secret though that off market, you tend to get better deals than you'll get on the market. Because often you're the only person that has spoken to that seller. And there's obviously a correct way to talk to a seller, maybe about, the fact that there's very long days on market to sell currently, all the things that are wrong with their property, all the things that would make it difficult for them to sell their property, basically making them be realistic about the current market and that it's a buyer's market. There are more sellers than buyers currently. So they're kind of lucky to have a bird in the hand today. A bird in the hand is worth two in the bush, as we say. It might not be exactly what the seller wants for a price, but it's close to it. So if they want, 500K for their property and we're offering them 460, but that's now, then, that avoids 1, 2, 3 months of them, wrestling with people coming through their home every week for open home inspections, etc. And the potential that 3 months, 6 months down the track, it may not have sold. That definitely happens too. Whereas this is a certain sale today. It's that immediacy and the fact that we can solve the seller's problem now. So to the right motivated person, that's attractive. It's your seller that wants to hold out for months to get the very highest price possible. We just don't even talk to those people. That's a complete waste of time. Yeah.
Absolutely. And do you mind if I expand on that one slightly? Because I think this is an important one, because I saw that there were a couple of people that asked questions around this. So you talked about the difference between being able to do it yourself and also doing it together with Byers Club. So if somebody wanted to do it on their own, what would you say about buying off-market properties on their own versus doing it together with Byers Club? What would be the advantages, disadvantages? And would you be able to give people some tips around doing it on their own, but also the advantages of obviously doing it with Byers Club instead?
Sure. That's a really good question. It really comes down to contacts in one word. You need to have people sending you those properties just before that seller goes and puts it on the market. If you don't have those contacts, there's no magic here, very difficult for anything to, for you to actually make any progress with that. So, I mean, absolutely, a person could kind of hunt down those contacts, go and talk to a whole bunch of agents in the area that they're interested in buying and say to the selling agent, hey, we're keen to buy something off market. Can you send it to me first? I've probably seen that sometimes that can work. I've also seen it not really work because you might have the selling agent go, oh, I'd prefer to take it to market, because the selling agent, obviously they have their own agenda, remember? So may or may not be possible, but yeah, absolutely you can go for it. I've just seen it probably with varied results here and there. I suppose versus, to answer the question, Menno, versus what we've been doing now for years, obviously we already have those established networks. We know that there's an ongoing stream of off-market properties coming through to us. So yeah, there's quite a reliable, consistent flow of properties that obviously we can get for our buyers.
Absolutely. Hope that answers the question for everybody, because I saw that there are a couple of questions around that.
Okay.
The other thing I wanted to very quickly address before I continue with some of the questions is Tim left a comment saying that he paid more than the original cost, and I'll just pull that one up for myself so I can double check that one. So he says, I'm already an existing client and paid more than 14,900 fee. Now there are discounts being offered. So obviously everybody that's in the room today has a great advantage over what Tim's been paying for his properties. So that's a great opportunity for people to be able to get in. So I was wondering if you could talk a little bit about the advantages of paying that 14,900, in this case, less if you're going to take action today.
Probably I'd say first and foremost, Menno, I'd say peace of mind. Yeah, obviously, like to use an analogy, if you brush your teeth every day, do you think you'd have much concern about whether you do it successfully? Probably not. You're pretty confident you can do it correctly. It's the same thing when you are in this game, you're buying properties every single day. It's there's not much you haven't seen. Like I can't even really think of a scenario I haven't seen before and my team haven't seen. So that's important because we just are going to know how to navigate through any situation. Bad things definitely can happen. I hope that came through in what I was talking about tonight. Definitely bad things happen, but because that's just life. If anyone that tells you things are always going to be blue skies is obviously not being truthful with you. So it's about how you respond to those situations when things go against you rather than throwing your hands up in the air. So beyond, I suppose, the leverage.
Also having a team.
Yeah, absolutely.
Like if you've got a team behind you, it's much easier than trying to navigate it on your own when bad things happen. Yeah. When you've got a team behind you that have experience, that have seen lots of different things, have gone through the different challenging scenarios.
Yeah, that's right. So yeah, like I mentioned before, property is a team sport. That's going to
make a great difference.
Yeah, so property is a team sport. So anyone that wants to actually have a significant number of properties will need a team, period. That might be us, or it could be your own team that you assemble. I suppose we provide the convenience that that team is already there. You don't have to go looking for all these people around Australia because we already have people in the cities around Australia. Yeah, so I think that's should be a takeaway tonight is, yeah, you can't do it yourself. Even if you're super bright, super resourceful, you are going to need a team. You don't want to necessarily be the smartest person in the room. You want to be a person connected to a network of people that you can trust. And then that also opens you up to being able to buy in other cities rather than just being the typical investor that only ever buys in their local area because they somehow think that's safer, and that the risk is somehow lower, which is really just a fallacy. That's not true.
Yes, I suppose in a way, you can do many things on your own, or you think you can. You can do it without Byers Club. But if you have a look at somebody like Arnold Schwarzenegger, for example, he talks very often about the fact that he doesn't want to be called a self-made man. Because there were people that brought him food and assistance and money and different other things that he needed when he first started out. And he wouldn't be where he is today without all of that assistance, without that team behind him.
Yeah, 100%. Yeah, I've read his book myself. I love the guy. I've got a massive poster of Arnold Schwarzenegger right there on the wall, actually.
Okay, Brendan. So in the meantime, we've still had a couple more questions come through as well that I haven't already compiled because they've been coming through as we've been answering the questions. Let me know how long you're still happy to keep answering questions, and I'll just keep throwing questions at you so that we can try and get through as many as possible, but let me know how long we can keep going.
Probably, I'm thinking it's more valuable one-on-one, Menno, with people. I find what I get through in a space of an hour or so with someone is far more valuable than a general presentation, because then I'm talking about real properties to the numbers of their borrowing capacity, price points, etc. So it's actually far more real and tangible rather than just a general presentation like this. So maybe another 2 questions.
Okay, so we've got a question from Galaxy S8. And the question is, what are the prerequisites to go through with this? Like, would I need credit score, capital, etc. to get started? So again, that's the kind of question that's more difficult in a general sense, but easier in a one-on-one. But yeah, I'll throw that question and one more.
Sure. Yeah, Menno, to answer that question, yes, our finance brokers would obviously do that for you in terms of getting a credit score for you. The credit file tends to
sign up to get the one-on-one to get the...
Sorry, Menno, you're just chopping up a little bit there on network. Yeah, so they would obviously get your credit file. That the lender does that after you've actually applied to a particular lender. Generally, look, it's pretty rare that people get knocked back altogether purely just based on credit score. Like you have to have screwed up really badly. It's usually like if people have defaults on their credit file that sits with Equifax, they keep those records. And also have those people have not rectified that and then paid that bill off. That's then a flag. Usually if people have paid it off, then it might be a change of interest rate for the default, but it often won't stop you borrowing altogether. In terms of capital, yes, generally you're going to need money from somewhere. So cash savings or pulling an equity out of another property, or you've got money in super. And you can put cash and super together as we talked about. So if someone had 50K in their retail super fund and 50K in their personal name, put that all together, that's 100K. That would be enough money for us to be able to buy a property, because you just need your 20% deposit and costs to come out of that 100K. Yeah, but all those are the borrowing capacity, the finance assessments, all of that. We do that both in someone's personal name and in their super fund. So you actually have 2 different borrowing capacities, which I can work out for someone in like 5 minutes when I sit down with them. We usually call my finance broker and he'll be able to tell you on the spot what that capacity is.
Okay, perfect. Thank you for answering that one as well. And then I've got 3 more. I think Williams has one about not being an Australian citizen, so it'd probably be better for him to have a chat to you directly about that one. And then the last 2 other ones would be, would 15,000 include building inspection solicitors and also arranging rental? And then there's one more and then we'll wrap up.
Sure. Short answer is no, it doesn't. Those are separate companies, so they are paid separately. Those fees, though, always will show up on a building and pest inspection, cash flow spreadsheet. So your building and pest inspection, your conveyancing, the property management, that is all there on, obviously conveyancing and building and pest go into the upfront costs. Your property management goes into your ongoing costs, which typically is covered by the rent, as I mentioned, because we're typically buying positive cash flow properties. Yeah, so but that's all itemized out for you. Yeah, that's quite clear.
Okay, perfect. And then the last question that I think would be good to answer is, somebody asked, would it be possible to also assist with off-market properties for your own main house?
Yeah, I saw that question. That's actually a good question. And yes, we do. So we buy both investment properties and home to live in. And yes, the same applies. A property is a property, whether you live in it or it's investment. Obviously they can still come from off-market contacts. Exactly the same mechanism. Yes.
Perfect. Then I would like to quickly say thank you to everybody for joining. There's a couple of people that have been asking whether recordings and slides will be available, and we will definitely make all of those available. I wanted to answer as many questions as possible, and I hope that we were able to answer all of your questions. If not, then obviously the one-on-one is still available for you to be able to get more detailed answers for yourself. And I am very thankful for everybody for coming. I hope you got a lot out of it. Is there any final words that you'd like to mention, Brendan, before we wish everybody good night.
I think that about wraps it up, Menno. Yeah, thank you so much to yourself and Igor for talking to your companies, to your people about the event, and yeah, I look forward to working with you guys a lot more in future. And yeah, likewise, I really appreciate the fact that people are spending time on a Tuesday night to learn a bit about property investing. It says a lot. Obviously, shows that you're taking the first step of action. You're serious enough to turn up to a webinar. But yeah, like I said, life rewards action. At the end of the day, action is the only thing, in my view, that really matters. So yeah, if you think that it's for you and you want to explore that further, then yeah, I'd encourage you to go to the inquiry page that I showed you and just book in for a consult. It's not going to cost you a cent, and I'm sure you're going to get a lot of value in terms of what I can tell you.
Okay, perfect. And I'd like to encourage everybody that would like to do that to do that. Have a great night. Thank you for coming. Well done for showing up and taking the time to learn more, ask questions, and take your future seriously.
Okay, fantastic. Thank you so much, guys. Bye, everybody. Thank you.
See you all next time.
Thanks very much.